Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden truths behind those dense corporate filings. Oh, and by the way, some of our numbers might be a little fuzzy because apparently someone forgot to pay the internet bill in 2025. It is a mystery. We'll definitely be decoding that today. We are diving deep into Westamerica Bancorporation. Its annual report for 2025. And trust me, this is not your typical dry financial document. It has got a story to tell, and we're going to find out what it is before we jump in if you love getting these unfiltered insights from SEC filings. Make sure you are subscribed. We also have a fantastic community growing on Discord linked in the description below. So come join the conversation. Alright, let's talk about Westamerica Bancorporation, or WABC, as the ticker symbol goes. This is a company operating in Northern and Central California, primarily serving small businesses. They've been around since 1972. And their focus is on banking services like loans and deposits. Now, every year they have to file this massive report with the CC telling everyone how they we're doing, and for 2025, some interesting trends emerge. Looking at the bottom line, this company reported a net income of $116.2 million for 2025. That is down from $138.6 million in 2024, and even further down from $161.8 million in 2023. So clearly there is a downward trend in profitability here. It's a significant drop year over year, and that is worth investigating. A big reason for this income drop is the reduction in net interest and loan fee income. It decreased by $33.6 million from 2024 to 2025. This means the money they made from the difference between interest earned on loans and securities and interest paid on deposits and borrowings went down considerably. This is largely because the average balances of their investment CA securities and loans decreased, and the yield on those securities also went down. The yield on their earning assets dropped to 4.06% in 2025 from 4.43% in both 2024 and 2023. This basically means the return they are getting on all the interest earning stuff they own has shrunk, which is a direct hit to their earnings, especially when you consider their funding costs, which also saw some changes the rates on their interest. Bearing liabilities increased in 2024 due to borrowings from the Bank Term Funding Program, a program that essentially allows banks to borrow funds from the Federal Reserve. Now, when you are dealing with banks, understanding how they account for things is super important, especially when it comes to loans and potential losses. They use a model called the Current Expected Credit Loss Model, or CECL, that tries to predict future losses on loans. This is a really subjective area and requires a lot of management judgment in 2025. They recorded a reversal of provision for credit losses, which sounds good, but it actually reflects a decrease in their estimated future losses. It is a number that could change if economic conditions shift. Speaking of loan losses, their total allowance for credit losses on loans decreased from $14.8 million in 2024 to about $11.6 million in 2025. So they are setting aside less money for potential loan defaults. This could be a sign of confidence in their loan portfolio, or it could be a signal that they are less concerned about future losses than they should be given the economic environment, especially with commercial loans seeing some significant charge-offs. On the flip side, their total non-performing loans also went up to $1.8 million in 2025 from about $735,000 in 2024. This means more loans are not paying as expected, and while the allowance for credit losses is still higher than their non-performing loans, that gap is narrowing. Let's look at their investment portfolio. They have a pretty substantial amount in debt securities available for sale, totaling over $3.4 billion at the end of 2025. A big chunk of this is in corporate securities, representing 60% of their total investments. This diversification is generally good, but it also means they are exposed to the ups and downs of the corporate bond market. When we dig into those corporate securities, about 57% are in the financial sector and 11% are in utilities. This is pretty standard for a bank holding company, but it is important to remember that a downturn in the financial sector could have a ripple effect on their investments. What is interesting is their significant position in collateralized loan obligations, or CLOs, which make up about 10% of their available for sale securities in 2025. Their CLO holdings decreased considerably from $983 million in 2024 to $425 million in 2025. CLOs can be complex instruments, and this reduction might indicate a strategic move to de-risk, or perhaps a response to market conditions. Looking at the rating of those corporate securities, the majority are investment grade, with about 65% rated A or A- and 25% rated BBB plus or BBB. This is a solid investment grade portfolio, which is reassuring given the interest rate environment we are in their investment securities. Available for sale had a significant unrealized loss of about $130 $1 million before tax. This unrealized loss sits in something called accumulated other comprehensive income on their balance sheet, affecting their overall equity without impacting net income directly. Now onto expenses. Their salaries and related benefits cost $48.7 million in 2025, a decrease from $50.3 million in 2024. This reduction likely stems from managing headcount or benefits to control costs, which ties into their overall efficiency ratio, which improved to 39.3% in 2025 from 35.4% in 2024, showing they are getting more bang for their buck. Their equity to assets ratio increased to 15.66% in 2025 from 14.65% in 2024, indicating a stronger equity base relative to their assets, which is a positive sign for financial stability. In terms of shareholder value, their common stock WABC has seen a bit of a dip in performance over the last decade compared to the S&P 500 and the Nasdaq Bank Index. The stock performance chart shows a cumulative return of about $138 on a $100 investment over 10 years, which lags behind the S&P 500's nearly $400 return and the Nasdaq Bank Index's $208. Also, their common dividend payout ratio has increased to 40% in 2025 from 34% in 2024, suggesting they are paying out a larger portion of their earnings as dividends. So what is the overall picture here? Westamerica Bancorporation is navigating a challenging economic landscape. Profitability is down primarily due to lower interest income, and that significant unrealized loss on their investment portfolio, while they're showing improved efficiency and a stronger equity position, the rising non-performing loans. And the stat, Antle holdings in corporate securities and close are certainly worth watching. The company's strategy seems to be focused on managing costs and maintaining a solid equity base, but the market pressures are evident in their stock performance and declining yields. The biggest risks they highlight involve interest rate fluctuations, economic downturn, earns in California, cybersecurity threats, and natural disasters, common themes for a California-based financial institution. However, their exposure seems relatively contained given their geographic focus and the nature of their business. The company is well capitalized by regulatory standards and appears to be taking steps to manage its risks diligently. Now, what does this mean for the future for Westamerica Bancorporation to regain its footing? It really needs to find ways to boost its interest income, potentially through strategic loan growth or by navigating the investment market more effectively given the current interest rate environment. They need to keep a close eye on those loan risks and ensure their provision for credit losses is adequate. If economic conditions worsen, the stock performance lagging behind major indices is a red flag for investors. And while dividends are consistent, the increasing payout ratio might not be sustainable if earnings continue to decline. The company is stable but perhaps not growing as aggressively as some of its peers. Perhaps a conscious choice given the market climate. What are your thoughts on Westamerica Bancorporation's 2025 performance and their future prospects? Do you think their strategy is sound, or are there red flags we should be more concerned about? Let me know your insights in the comments below. If you found this deep dive valuable, do us a favor and hit that like button. It really helps us out. And of course, subscribe for more corporate breakdowns just like this. And hey, don't forget to join our Discord community, linked in the description for even more in-depth discussions. Thanks for watching. See you next time.